The reason housing is breaking everywhere at once isn't supply, isn't demand, and it isn't interest rates. It's debt. Not household debt, not mortgage debt, government debt. While everyone is arguing about whether prices will crash or stay high, something much bigger just crossed the line, quietly. For the first time in history, the United States now owes more money than its entire economy produces in a year. And when countries cross this line, housing doesn't collapse overnight. It breaks slowly. Buyers disappear. Sellers get trapped. Homeowners feel richer on paper, but poorer in real life. This isn't 2008. There's no clean crash coming to reset the system. What's happening now is worse. Because this time, housing isn't falling, it's bleeding. The line that changed everything. For a long time, the housing market looked like it was breaking for a dozen different reasons. Interest rates were too high. Inventory was too low. Prices were too sticky. Buyers were exhausted. And depending on who you asked, that was the problem. But quietly, without a headline or emergency press conference, the United States crossed a line that changes how all of this works. For the first time in history, U.S. government debt officially exceeded 100% of GDP. That means the country now owes more money than its entire economy produces in a full year. And this isn't just another scary statistic. This is a historical threshold. Because when countries cross this line, housing doesn't behave the same way anymore. Not because people suddenly stop needing homes, not because builders forget how to build, but because the system that finances housing starts to crack. According to the Committee for a Responsible Federal Budget, once debt passes this level, the trajectory becomes unsustainable. But here's the uncomfortable truth. It was already unsustainable long before anyone officially admitted it. The only difference now is that we've run out of room to pretend otherwise. At this point, the government has three theoretical options: cut spending, raise taxes, or borrow and print even more money. Cutting spending sounds good on paper, but politically it's a dead end. Housing subsidies, infrastructure, entitlements, no one wants to be the one holding the scissors. Raising taxes? That's even worse. The moment taxes go up meaningfully, consumer spending drops, housing demand weakens further, and politicians lose elections. So what's left? Borrow more, print more, kick the can further down the road.
And this is where housing gets pulled into the blast radius. Because housing doesn't just respond to supply and demand, it responds to confidence. Confidence in income, confidence in financing, confidence that the rules won't change mid-game. Once national debt reaches this level, that confidence starts eroding, slowly at first, then all at once. And we've seen this pattern before, not just in one country, but over and over throughout history. When debt reaches a critical mass, governments don't suddenly become responsible, they become reactive. They wait until markets push back, until bond investors demand higher yields, until borrowing costs spike, until something breaks. And when that happens, housing is never spared. Not because housing caused the problem, but because housing sits at the intersection of credit, debt, and household balance sheets. This is why what we're seeing right now doesn't look like a normal housing cycle. Prices aren't collapsing, but affordability is. Sales aren't freezing because buyers disappeared. They're freezing because buyers no longer trust the math. And sellers aren't winning either. They're trapped, locked into low rates, high taxes, and rising costs. This is what happens when a country crosses a line it can't uncross easily. From this point forward, the question isn't whether housing will be affected, it's how the pressure gets released. Through higher taxes, higher inflation, financial stress, or all of the above. And the first place that pressure shows up isn't Wall Street, it's housing. When a country crosses a line like this, nothing breaks all at once. First, confidence cracks. And the moment confidence cracks, markets don't wait for permission. They move, quietly at first, then violently. And the first place that reaction shows up isn't housing, it's the bond market.
When markets panic, housing pays the price. For most people, the bond market feels distant. It sounds technical, boring, unrelated to everyday life. But the bond market is where the government actually borrows money. And when confidence in government finances starts to fade, this is where things break first. Here's the scenario. Investors begin questioning whether U.S. debt is still risk-free. Not because the country is about to collapse tomorrow, but because the math no longer works long-term. When that happens, bond buyers demand higher yields, interest rates spike, bond prices fall, and suddenly the cost of financing everything goes up at the same time. Not just government spending. Mortgages, construction loans, commercial real estate, refinancing. This is what a political panic looks like in real life. Lawmakers get boxed in. They're forced to choose between sudden spending cuts or massive tax hikes. And here's the problem. You don't do fiscal tightening in a weak economy without breaking something. If the government tries to cut spending aggressively or raises taxes to stabilize debt, it pulls demand out of the economy. Jobs slow, wages stall, housing demand weakens further. Even a fiscal contraction equal to just 5% of GDP would trigger a recession worse than anything we've seen since 1950, worse than 2008. And that's not speculation.
That's based on historical outcomes. We've seen this movie before. In Greece during the 2010s, bond yields exploded. Emergency measures were rushed through. Unemployment surged. Living standards collapsed. Housing didn't crash cleanly, it froze. People couldn't buy, people couldn't sell, and homeowners watched real wealth disappear without prices ever fully resetting. Smaller versions of this played out in Portugal and Spain. Different countries, same pattern. Once markets lose confidence, governments don't regain control, they react. And housing always gets caught in the middle, because housing depends on cheap credit, predictable policy, stable financing. The moment those assumptions crack, housing liquidity disappears. Buyers step back, lenders tighten, builders pull projects, sellers wait and wait and wait. This is why today's housing market feels stuck, not crashing, not recovering, frozen. And while everyone is watching home prices, the real danger is building underneath, inside the financial system itself. Because if the bond market doesn't just panic, but breaks, then the consequences get much worse. When the bond market breaks, credit disappears. Here's where this stops being theoretical. Because when bond markets don't just panic, but actually break, the damage doesn't stay on trading screens. It hits the banking system. Banks don't hold cash. They hold bonds, government bonds, mortgage-backed securities, assets that were once considered safe. So when yields spike and bond prices fall, those safe assets suddenly turn into massive losses on bank balance sheets. That's exactly what we saw in early 2023. A few banks failed, not because they were reckless, but because rapid rate hikes crushed the value of the bonds they were holding, and the government stepped in. Deposits were protected, losses were absorbed, the crisis was contained. But what happened in 2023 wasn't the crisis, it was the warning shot. Because that was with a handful of banks. Now imagine the same pressure hitting the system all at once. Banks respond the only way they can. They stop lending. Credit tightens. Underwriting gets stricter. Down payments rise. Appraisals get conservative. Construction loans dry up. And housing doesn't collapse, it suffocates. This is how a credit-driven housing slowdown actually works.
Buyers don't disappear because prices are too high. They disappear because financing becomes unpredictable. Sellers don't panic sell. They wait, locked into low mortgage rates they can't replace. Builders cancel projects. Developers walk away from land deals. Renovations stop. Liquidity vanishes. We've seen a version of this before. During the last major housing collapse, home values fell roughly 30% over 5 years. Unemployment hit double digits. Economic output shrank. And even with massive government intervention, near-zero interest rates, trillions in stimulus, years of support, it still took a long time to recover. And that was under ideal conditions. Today, conditions are worse. Rates are higher, debt is larger, inflation is already embedded, and the government has far less room to maneuver. So if the bond market breaks this time, there's no clean reset. There's no quick rescue, just tighter credit, slower growth, and a housing market that can't breathe. And when credit disappears, the system faces a choice. Do you allow defaults? Do you let banks fail? Do you let housing prices reset violently? Or do you step in and print? Because once the financial system is at risk, there's always one option that wins.
Print or collapse. When the system reaches this point, the choice isn't philosophical, it's mechanical. Either you allow the financial system to break, or you print. Governments don't debate this for very long. They print. Because defaults are visible, bank failures are visible, housing crashes are visible. Printing, on the other hand, hides the damage, at least at first. This is called monetizing the debt. The central bank steps in, buys government bonds, supports banks, and keeps the system liquid. No emergency announcement, no official crisis, just more money entering the system. And on the surface, it looks like stability. Markets calm down, banks survive, housing prices stop falling. But the cost doesn't disappear. It moves from balance sheets to purchasing power. This is where inflation accelerates. Savings lose value, wages fall behind, everyday costs rise faster than incomes, and housing becomes unaffordable in a completely different way. Not because prices explode overnight, but because everything around housing gets more expensive. Property taxes rise as governments scramble for revenue. Insurance premiums surge. Maintenance and materials cost more. HOA fees quietly increase. Mortgage rates stay elevated because bond buyers demand compensation for inflation risk. So even if home prices stall, monthly payments don't come down.
This is the housing trap. Owners feel richer on paper but poorer in reality. Buyers can't qualify, renters can't save, and moving becomes financially irrational. This is why housing today doesn't look like 2008. There's no crash that resets affordability. Instead, there's a slow bleed. Every year, housing takes a little more from household cash flow and gives a little less back. And this isn't accidental. Inflation is the most politically convenient tax. It doesn't require a vote, it doesn't show up as a line item, and it spreads the cost across everyone, especially homeowners and renters. The more the government prints to support debt and banks, the more housing becomes a pressure valve, absorbing inflation, absorbing taxes, absorbing financial stress. This is why you can feel like you're doing everything right, owning a home, building equity, paying your bills, and still falling behind. Because the system isn't designed to stabilize housing anymore. It's designed to use housing, to prop up debt, to preserve the illusion of stability, to keep the show going just a little longer. And as long as printing remains the least painful option, this path doesn't change, which leads to the most dangerous phase of all. Not a crash, not a recovery, but something much harder to escape. The slow bleed nobody can escape. This is the phase that confuses people the most, because nothing breaks. There's no crash, no emergency headlines, no dramatic reset. Housing prices don't collapse. In many places, they barely move at all.
And that's exactly the problem. What replaces the crash is something quieter, something more exhausting, a slow bleed. Year after year, housing takes a little more without giving relief back. Buyers don't get a moment where things suddenly become affordable. They just watch down payments grow faster than their savings. Sellers don't get an exit. They're locked into mortgages they can't replace, tax bills that keep rising, and transaction costs that make moving irrational. Homeowners technically win until they look at their cash flow. Insurance up, taxes up, maintenance up, HOA fees creeping higher. Equity grows on paper, but disposable income shrinks in real life. This is why housing no longer feels like stability. It feels like responsibility without flexibility. And the damage compounds, because when housing drains cash flow, people delay everything else. They postpone having kids. They delay medical care. They put off repairs. They stop taking risks. Economic mobility slows, not because people stopped trying, but because the system quietly raised the cost of participation. This is how a high-debt economy behaves. Growth doesn't stop, it just weakens. Wages rise, but never enough. Jobs exist, but feel fragile. Opportunities shrink at the margins. We've seen this before. Japan avoided a housing crash for decades. Prices stagnated, debt piled up, interest rates stayed low, and an entire generation learned to expect less. Less growth, less opportunity, less upward movement. The country didn't collapse, it just stopped moving forward. That's the danger of the slow bleed. It doesn't feel like a crisis, so nothing gets fixed. Politicians point to stable prices. Economists point to resilience. Markets move on. Meanwhile, households adjust downward. They normalize stress. They accept stagnation. They shrink their expectations. And housing becomes the anchor. Not because it's failing, but because it's absorbing everything else. This is why housing today feels frozen in time. It's not 2008, and it's not a boom. It's a system stuck between inflation and debt, using housing as the pressure valve. And the longer this continues, the harder it becomes to reverse, because the slow bleed doesn't end with one decision. It ends when something finally forces the system to change. And when that happens, it won't start in housing, but housing will feel it the most. There is no reset coming. If you're still waiting for a reset, you're not alone. Millions of people are waiting for the same thing. Waiting for prices to fall, waiting for rates to come down, waiting for wages to finally catch up, waiting for housing to make sense again. But here's the uncomfortable truth. The system isn't designed to reset anymore. It's designed to endure. When debt was small, resets were possible. Recessions cleared excess, crashes wiped the slate clean. Pain was sharp but short. That world no longer exists. Today, the debt is too large, too interconnected, too politically dangerous to unwind quickly. So instead of resets, we get management. Instead of collapse, we get containment. Instead of crashes, we get freezes. And housing is the centerpiece of that strategy, because housing touches everything: banks, local governments, pensions, household wealth, voter psychology. If housing breaks too fast, confidence breaks with it, and confidence is the only thing holding a high-debt system together. So policymakers don't aim for affordable, they aim for stable enough. Not stable for buyers, not stable for renters, stable for the system. That's why the signals feel so confusing. You hear that the economy is strong, but people feel stretched. You hear unemployment is low, but job security feels fragile. You hear housing is resilient, but nobody feels relieved.
That contradiction is the point. This is what a managed system looks like.
Housing prices are defended, not because they're healthy, but because they're necessary. Rates are adjusted, not to help buyers, but to prevent panic. Inflation is tolerated because it quietly reduces debt without forcing defaults. Nothing explodes. Everything erodes, and erosion is hard to see in real time, especially if you already own a home. On paper, homeowners look fine. Equity is up, loan rates are locked, values haven't collapsed. But look closer. Mobility is gone. Selling means losing a low-rate mortgage. Moving means higher taxes and insurance. Downsizing doesn't free cash the way it used to. So people stay, not because it's optimal, but because it's safer than changing anything. That's how a market freezes. Buyers hesitate, sellers hesitate, builders hesitate, employers hesitate. Risk disappears. And when risk disappears, growth disappears with it. This is where the housing story stops being about houses. It becomes about time. Years spent waiting for conditions that never fully arrive. Years where decisions are delayed, not because people are irresponsible, but because the downside feels too large. You don't start a family. You don't switch careers. You don't relocate for opportunity. Not because you don't want to, but because housing makes every move expensive and irreversible. That's the hidden cost of debt. It doesn't just raise prices, it traps choices. And the people hit hardest aren't the ones already inside the system. It's the ones trying to enter. First-time buyers aren't being outbid, they're being outlasted. They're told to be patient in a system that monetizes their patience. Renters absorb inflation. Savers lose purchasing power. Workers chase wages that lag behind asset prices. And housing sits above all of it, protected, immobile, untouchable. This is why there is no clean ending to this story, no moment where housing suddenly becomes fair, no year where affordability magically returns, no policy that fixes it without breaking something else. Because any real fix would require admitting the truth, that the system grew on debt, and debt always demands a payment. Not all at once, but eventually, from someone. And increasingly that someone is time, mobility, and opportunity. So what does this mean for you? It doesn't mean panic, and it doesn't mean paralysis. It means clarity. Understanding that housing is no longer a ladder, it's a position you enter carefully, a position you hold deliberately, a position you exit only when the trade-offs make sense. Not because prices are about to crash, and not because they're about to soar, but because the system will protect itself first, and people second. This isn't pessimism, it's realism in a high-debt world. Housing didn't fail overnight. It wasn't mismanaged by accident. It was chosen, slowly, deliberately, as the place to store everything the system didn't want to confront directly. And until that changes, there is no reset coming, only decisions made with open eyes.
If you made it this far, thank you for staying with the full picture. Most videos talk about housing like it's a game. Buy low, sell high, wait for the crash. This channel is about something different. Understanding the system you're living inside, so you don't make decisions based on headlines, hope, or fear. If this helped you see housing more clearly, not more optimistically, but more realistically, consider subscribing. New videos break down housing, debt, and the economy the way they actually work together, not to predict the future, but to help you navigate it. Thanks for watching. I'll see you in the next one.